If you look at your bank account right now, you see a number. You believe that number represents value. You believe it represents safety. But what if I told you that the wealth of the modern world is a hologram? We are living through a unique moment in human history, the age of paper wealth. Global GDP, the value of everything humans produce in a year, is roughly $100 trillion. But the value of the global financial markets, the stocks, the bonds, and the derivatives, it is estimated to be over $1 quadrillion. That is a number so large the human brain cannot comprehend it. It is 10 times larger than the value of every good and service on Earth. So ask yourself the forbidden question. If the financial system claims to be worth 10 times more than the real world, what is backing the difference? Nothing. It is a bet, a promise, a hallucination. We have built a civilization not on bricks and mortar, but on leverage and liquidity. And in the laws of physics, leverage always unwinds. We are approaching the global margin call, and when the phone rings, the paper wealth will simply vanish into the ether from which it came. To understand how we broke reality, we must visit the man who invented the bubble. His name was John Law. The year was 1716. France was bankrupt. The king was dead. The gold was gone. John Law, a Scottish gambler and mathematician, approached the regent of France with a radical idea. Money, he said, is not gold. Money is confidence. He convinced the government to let him print paper notes backed not by gold, but by the potential wealth of the Mississippi Company in America. It worked. Too well. The shares of the Mississippi Company skyrocketed. People became rich overnight. John Law literally coined the term millionaire. Servants became lords. Lords became kings. Paris was awash in paper wealth. The economy boomed. But there was a problem. The Mississippi Company wasn't actually digging up any gold in America. It was just a swamp. The wealth was imaginary. When the people realized the paper had no link to reality, they rushed to convert it back to gold. But there was no gold. The illusion collapsed in weeks. The millionaires were starving in the streets holding bags of worthless paper. France was ruined for a generation. You would think we learned our lesson, but we didn't. We just scaled it up. Today, the entire global economy is the Mississippi Company, and the Federal Reserve is John Law. In 1980, the financial sector, banks, insurance, real estate, made up a small fraction of corporate profits. The business of America was business, making cars, building bridges. Today, the business of America is finance. General Motors is not a car company anymore. It is a hedge fund that sells cars on the side to finance its loans. Apple makes more money from its financial engineering and stock buybacks than it does from selling iPhones. We stopped building things and we started betting on things. This is called financialization. It creates the illusion of growth. If a company borrows cheap money to buy its own stock, the stock price goes up, the GDP goes up, the politicians celebrate. But no new value was created, no new factory was built, no new technology was invented. It is financial cannibalism. We are eating the muscle of the economy to feed the appearance of health. The stock market is no longer a measure of the economy's health, it is a measure of the economy's leverage. But stocks and bonds are just the tip of the iceberg. The real danger, the quadrillion-dollar danger, lies in the shadow market. Derivatives. Warren Buffett called them financial weapons of mass destruction. A derivative is not an asset. It is a bet on an asset, or a bet on a bet, or a bet on the weather or the interest rate or the currency fluctuation of a country you couldn't find on a map. Imagine you own a house worth $100,000. I bet you $1,000 that your house will burn down. Then a banker bets someone else $10,000 on whether I will win my bet. Then a hedge fund builds a complex algorithm to bet $1 billion on the volatility of those bets. Suddenly, there is $1 billion of paper value tied to a $100,000 house. If the house survives, the bets pay out, and everyone feels rich. But if the house burns, the chain reaction detonates. This is the 2008 crisis. It wasn't about mortgages, it was about the bets on the mortgages. And since 2008, the derivatives market hasn't shrunk, it has grown. The global banking system is interconnected by a web of these promises. Deutsche Bank, JP Morgan, the Bank of Japan. They are all counterparties to each other's hallucinations. If one major player fails to pay a margin call, the hole in the balance sheet is larger than the GDP of entire nations. This brings us to the trigger. What pops the bubble? Liquidity. Liquidity is the water in the pipes. It allows you to sell an asset without crashing the price. In a bubble, everyone thinks they are liquid. You think you can sell your stocks instantly. You think you can sell your house in a month. But liquidity is a coward. It disappears exactly when you need it most. When the panic starts, everyone rushes for the exit at the same time. But in a derivatives crisis, there is no buyer. Who takes the other side of a trade when the world is ending? No one. Price discovery breaks. The screen goes blank. The quadrillion dollars of wealth simply evaporates. It wasn't stolen, it never existed. It was a psychological projection, a confidence game, and confidence is the most fragile currency of all. The financial historian does not predict the when, he predicts the what. And the what is a return to mean, a return to reality. We are moving from a world of financial abstractions back to a world of tangible consequences. When the everything bubble pops, the wealth that remains will be the wealth that you can touch. Energy, land, food, metals. The illusion is comfortable. The matrix is pleasant. But you cannot eat a derivative. You cannot live inside a stock buyback. The global margin call is coming. The brokers will demand collateral, and they will not accept paper promises. They will demand the real. Will you have any left? This is the financial historian. The theater is on fire. Find the exit.